All right, looks like we are live. Hello, Bigger Pockets. We are live on Facebook. Let's go ahead and have the Instagram group join in, and we will get rolling here. So, all right, looks like we're live on Instagram. Perfect. Okay. All right, everybody. Andrew Cushman here for part 8 of our 8-week series on how to buy your first or 10th multifamily property. And just as the title says, we're walking through all the different steps for you either to get into the game of multifamily or how to scale and go bigger and go to new markets and really build your business. So, we got a lot to cover today, so I'm going to jump right in. For those of you who don't know who I am, again, it's Andrew Cushman. I've done about 2,100 apartment units via syndication in the last 10 years. I've been on the Bigger Pockets podcast a couple of times. So I believe it's episode 170 and 279. So if you want to hear my full backstory, just go take a listen to that. And if you're watching this on Facebook, you consider yourself lucky you get to see the slides. If you're on Instagram, unfortunately, the slides don't come through on Instagram. So if you can make it over to the Bigger Pockets Facebook page, you will see the slides there. However, if you can't do that or you can't see the slides, this is being recorded, and you can go to Bigger Pockets and search for the recordings, and all of this will come up. So as you're joining, please let us know where you're coming from. You have Goodman W. Hello from New Jersey. I love hearing where everyone is coming in from. So please let us know what state or even country you're from. We had a couple people from South America last time, so that's always fun. And also, please remember to hit the like button, share, and hearts on Instagram so that we know that what information is helpful to you. And if we see that it is particularly helpful, then we'll spend a few more minutes and try to dive in. Also, this is meant to be interactive. So, hey, Sean from Boston, Massachusetts, used to live there. I also used to live in Dayton, Ohio, or near Dayton, Ohio. And we've got the Marie from Atlanta, great place to invest. And inspecting SD from San Diego. I was down that way earlier this morning. And on Facebook, we have Jennifer from Tucson, Arizona. So thank you, everybody. Appreciate all that. We've got people from all over the country. It always makes it fun and exciting to do this. And let's jump right in. Like I said, we got a lot to cover. And if you missed any of this, again, the recordings are on Bigger Pockets. So we're on step 8. What were the first 7 steps? The first one was, how do you pick a market, right? Maybe you live in San Francisco, not the best market for cash flow, so you want to go somewhere else. How do you do that? That was step 1. 2, once you've got that market identified, how do you build a team in that market? And then 3, okay, you've got people, you've got a market, you've got people on your team, both remotely and internally, and now you've got deal flow coming in. How do you screen those deals and figure out which ones you actually want to spend time on, right? That was step 3. Step 4 is, hey, I got 10 deals in my inbox today. 2 of them passed screening and look pretty good. How do I underwrite those 2 to determine if I want to make an offer? And if you're going to make an offer, what is that offer? How much can you pay? Under what kind of terms? Number 5 is week 5 was the process of how do you actually make that offer? How do you put together an LOI? How do you negotiate a purchase and sale agreement, and all of those factors, which is very key, especially the purchase and sale agreement. Part 6 was, congratulations, you got your offer accepted. They signed the contract. Now you need to do your due diligence, right? You need to inspect the property physically. You need to inspect the financials, title, all that kind of stuff. So we covered that. Well, our last session 2 weeks ago, we talked about financing and debt strategy and how do you use debt to mitigate future interest rate risk or inflation, and how do you match the type of debt with your business plan for the property. So we talked about that. And then finally, step 8 today is where the real money is actually made, right? Everyone says in real estate, oh, you make your money when you buy. In multifamily, that's not really true. In multifamily, buying right is a big piece of it. Putting the right financing on it is a big piece of it. But where you really, really make your money is good, solid asset management. Notice I didn't say property management, I said asset management. So we'll get into what the difference is. So let's go ahead and jump in. I do want to actually got a question here on Facebook. Maninder Singh, hopefully I got that close to right, says, what do you think about the eviction moratorium? Obviously, well, I shouldn't say obviously. Preferably we wouldn't have the government jumping in and changing the terms of contracts and agreements. However, I will say that the eviction moratoriums have not really been a problem so far, at least not in the B to A minus space, because most people, contrary to what the media has been telling us, most people are paying their rent. And on top of that, those who can't, there's lots of assistance available for them to get the money to pay their rent. And that's how we've been dealing with the moratoriums, is we've been very proactive about connecting our residents with the assistance programs so that they can get caught up and keep paying. So, you know, while we don't prefer moratoriums, we've been able to navigate around it just fine. And out of every 100 units that we control, we might have one, maybe two people that are sitting there not paying, that we can't transition off the property. So it is definitely something that everyone's dealing with. If you've got a duplex and you got one person who stops paying and they refuse to work with you, yeah, that can be a serious problem. But that's part of why we're here today, to help everybody get into larger multifamily, because if you've got 10 units and one person stops paying, you're probably going to be okay. You can still pay the expenses, still pay the mortgage, right? So let's go ahead and jump in. I wanted to address that right away. Thanks for bringing that up. All right. So again, main topic today, asset management. So I do want to throw out a question for everybody who's watching on Facebook and Instagram. And the question I want to throw out there is: do you self-manage or do you use third-party management? Right. So please go ahead and throw your answers in the question. I'm sorry, in the question. In the throw your answers in the feed and Instagram and in the comment section on Facebook. And if you can, when you say that, when you say yes, I self-manage or I use third-party, be curious if that is like a couple of single families or large multifamily. So we have Jana on Facebook, self-managed. Jennifer on Facebook also self-manages. Let's see, we got, all right, Instagram, we've got third party, self-manage. We've got another third party on Facebook, and a couple more self-managing on Instagram. So we've got a pretty good split here. And yeah, okay, here we go. Perfect. Thank Ricky on Instagram. He does both. And then we have Simple K. Yes, I self-manage single family home. Bunch of single self-managers, and then Nick on Facebook, third party. So we've got a pretty good mix here. And I will say, some people say, "Oh, should you self-manage or do third party?" It really depends on you and your business structure. So I'm going to talk a lot in terms of third party, which I would say the larger you scale, the more third party makes sense. But if you're, and also partially because, candidly, the smaller properties that you're managing, the harder it is to find good third party property management. Chacha McDaniel on Facebook says self-managing for now, right? That sounds like someone who's going to grow real big. So all right, cool. We got a good split, and we'll kind of address the self-managing versus third-party management as we go. A lot of what we're saying now is in terms of, or framed in the terms of third-party property management. But if you're self-managing, just what you think of it as taking out that middle layer, right? So if eventually, if you get enough units and you're self-managing, you're probably gonna have a maintenance person or maybe a grounds person. You're gonna have other people on your team, and you want to apply these same principles to the management of your own property. So the main topics we're going to cover here that are part of asset management are forming your team within the framework of asset management, timing and methods of communication. How and when do you communicate with these people? Monitoring your financials. And again, this applies whether you're putting them together yourself or you have a third party. How do you align the interests of either your third-party property management or the people that are helping you manage your properties, right? How do you make sure that your interests are aligned? And then the big one, disposition. How do you hear nightmare stories about you go to put a property up for sale and everybody quit, everyone quits, or the management company just doesn't care anymore and the whole thing goes down the toilet. How do you prevent that from happening? We've got a great example. We're selling a property right now, and we'll go through kind of what we did and how that worked. So, TLC Marie just made a really good comment here on Instagram. She says, "I prefer not to tie up my time and move towards third party." That really is the key. If you're self-managing because you enjoy it, or that's, you've maybe retired and that's what you want to do, or you're doing it to learn the ropes, that's great. But if you are looking to scale and grow, really your highest dollar value is as an investor, finding deals, putting them together, closing them, getting investors. If you're bringing in outside money, that's your highest dollar value. Property management tends to be low return, high headache, and you really tend to be, it's more of an HR function of an HR firm. Not that it's easy. It is definitely not easy. But that's really, yeah. So Fearless here put a comment, just learning the systems right now. That's the right attitude. That's the right approach, at least in my opinion. We did self-manage also in the very beginning, and then we quickly, once we knew the ropes, we switched over to third party, and of course now we know how to manage them. So great, Kyle. I really appreciate all the feedback, everyone. This is good. It makes it a little bit more fun. So, all right, forming your team. So here, forming your team is in terms of picking a third party management company. If you're saying, well, I don't use third party and I don't want to, then see this in terms of, okay, maybe you are the only person involved right now, but eventually if you get enough rentals, then you're going to at least bring in an assistant or an admin or somebody. Otherwise, you're just going to run out of time and be stuck, and you're not going to grow anymore. Okay. So a quick question on Instagram. Avery Ritchie Life says, is 10% the right number to estimate for cost of third party? That's a very safe number. That depends on the size of your asset and the market you're in. So if you're looking at 10 units and under, 8 to 10% seems to be market, seems to be normal. If you're looking at, and then that goes down as the asset gets larger. So, on stuff that's 100 units plus, it should, most common is 3%, sometimes 4%, but, we pay 3% on all of our assets. But yes, if you're 10 units and under, 8 to 10%, very common, seems to be, again, about market. And then you truly are being an asset manager, and you're making sure that they are earning that 8 to 10%. So how do you find a third party manager, either now or when you grow to that person? First, grow to that scale. First, build a referral list, right? So every time, when you go to a new market, you're talking to a broker, a lender, or anybody in that market, say, hey, if you were to buy this property, who would you hire to manage it for you, right? Build that list. And so, like, for example, when we went to Atlanta for the first time, 10 years ago now, that's what we did. We built it, and we got a list of like 10 management companies. Then my wife is my business partner. She went and researched online and found a bunch of dirt, and we eliminated about half of them. So, okay, these guys aren't any good. They got junky properties, really bad reviews, lawsuits. That eliminates half of them. Then we did phone interviews. That's the third step. And you want to talk to as someone as high up in the company as possible. If it's a smaller company, ideally it's the owner. If it's a larger company, it might be a regional or vice president or something like that. So we did phone interviews to narrow it down to like 2. And then I flew out to Atlanta, sat down and had dinner with the owners of the top 2 candidates, and then picked one that we felt was the best fit. And through that rather long process, on our first try, we got an incredible property management company that does a phenomenal job for us. So that's how you find a good property management company. I definitely don't just run out and hire the first one that you find or that comes to mind, or, oh, these I got a couple of referrals, I'll just pick one. Just like hiring an employee or bringing on a partner, you want to really take the time to make sure that you're getting it right in the beginning, and it'll pay huge dividends on the back end. So, all right, so that's how you find your third party management. So, here's some of the questions that you want to ask during that process. You want to ask, what is their background? So the people who own the company or run the company, did they just start it 2 years ago and they're just learning, or Did they maybe come from were they former executives at a much larger company, or are you actually just dealing with a larger company that's been doing it for decades? What kind of property do they specialize in? If you have a fourplex that's a C-class property, you don't want to hire a management company that specializes in luxury class A properties, right? They're not going to run it efficiently. So you want to make sure that you get a company that specializes in the type of asset that you own and or are looking to purchase, right? What does their leadership look like? I kind of touched on this before. The people who founded the company, what is their background? Why did they start the company? What are their long-term goals for the company? Are they looking to grow it and sell it in 5 years, and all of a sudden you're going to be dealing with a whole nother group of people that you have no idea who they are? And then also, who's going to be leading your properties, right? Because a lot of companies, you've got owners, then you've got, you have various levels. You have vice president, then you have the regional managers, then you have an actual property manager. What does their structure look like, and who's actually going to be hands-on with your property? And you want to get to know that person and get a sense of how good of a job they're going to do. And then also you want to know how many units they have in the market, right? If you're, buying in Dallas, you probably don't want to pick a management company that only manages 100 units. But you also, on the flip side, in our experience, management companies that manage 40,000 units also aren't the best, because you're just a line item on their spreadsheet, right? So what we found is mid-sized management companies seem to be the most effective. They are big enough to have the resources to give you leverage that you won't have on your own. But they're small enough to still care about you and your properties and the results that they get with those properties. So what I mean by mid-size is 2 to 10,000 units. Again, that's not a hard, fast rule. We've just found that seems to kind of be the sweet spot. And if I were to go to a complete new market, if I was going to go to Boise, Idaho today and start trying to buy properties, I would be looking for a management company that is probably about that size. So that's how you find those are some of the questions you asked. You asked that. We've definitely expand on that. We have a list of, I think, 27 questions that we haven't had to use in a while, because we got this process got us a great management partner to begin with. But those are some of the main topics that you want to start with. And also, don't forget, we will try to work in questions. So if you have something, go ahead and post it in the feed on Instagram, and hit the hearts, and then Facebook, like and comment, and I'll try to work those in. And if we get done early enough, I will try to go back and catch some of those questions. But the best is if we can try to grab them as we go. Let's see. Bearded Marco says, can I watch series 1 to 8 somewhere? I want all this good stuff. Yes, you can. And I apologize, I don't remember the URL off the top of my head, but Bigger Pockets does have all 8 of these recorded, and they are available to members. So you can go back and watch all 8 of these, and the slides will be there, and you can take your time, and you're welcome to copy the slides and use the information for whatever might help you grow your business. All right, I'm gonna grab a sip of coffee and move to the next slide. Hey, there we go. All right. On-site, if you're buying larger properties, 100 units on up, on-site staff means exactly what it sounds like. Staff that are at the property from 8 to 5, 5 or 6 days a week. A lot of times they'll actually live there, and they are literally on site. If you have single-family rentals, duplexes, fourplexes, 10 units, they're generally not going to literally be on site, but because there's usually those properties aren't big enough to economically support someone who's there full time all day. But look at it as, okay, maybe they're not literally on site, but see it as the people that interact directly with your property, right? So maybe it's you hire a management company, and the person that comes out to tour units with applicants, see that person as your on-site staff, because they're the ones that are showing up at the property. They're whoever interacts the most with your residents and future residents. So when you're evaluating on-site staff, attitude and demeanor trumps almost everything else, right? For those of you who've gone through Chick-fil-A, they're now the number one fast food franchise in the country. And one of the biggest reasons is they are known for amazing customer service and positive attitude. And just about every time you interact with anyone at Chick-fil-A, it's a good experience, right? And you could generally come away with feeling good about the person that you interacted with. That's the kind of person that you want at your property. Again, whether it's full time every day or just they're the ones that they've got a bunch of properties and they're going to come interact with your with your residents. So some of the first questions to ask yourself: is the current staff talented? And again, that can be for us the most important thing is attitude and demeanor, but it also does mean skills and experiences. When the current owner sells the property, are those staff going to stay there? So that really comes into play if you're looking at larger properties. If you're buying a 10 unit, there's probably not going to be staff assigned to it. So you don't necessarily need to worry about that. You just need to make sure that whoever you're bringing in, either someone that's directly working for you or through third party, what their skills and attitude and demeanor are. The next thing for on-site staff is, what is the scope of work on the property and can the staff execute the business plan? If you're buying 20 units that are highly distressed, maybe it's halfway vacant and needs a ton of renovation, you're gonna be spending a bunch of money on it. You need to make sure you have the people in place who can properly not only manage that renovation, but also get those units released and keep everything on a good pace and a good schedule. Also, evaluate, how many staff will it take to run the property? If you've got 10 units, you should be able to work with your property management company and figure out, okay, this is going to take them roughly, 6 hours a week, right, to run your property. If you've got 100 units, or once you start getting to bigger properties, generally speaking, for every 100 units, it's one person in the office and one person doing maintenance. And then, that scales up. If you do 200, it's two people in the office, two people doing maintenance. So that's how you look at on-site staff. And then, basically use your site inspection or your due diligence as kind of an informal interview. So if you're looking at big stuff and you're walking around, talk to the maintenance guy or maintenance person, talk to the manager, kind of get a feel of who they are, and like I said, ask a lot of questions. That kind of is basically like an informal interview. See how well they know the property, the market. If you're buying a fourplex or a 10 unit that doesn't have on-site staff, ideally during your due diligence, your management company is going to send somebody to assist you in evaluating the property with due diligence. And you want to do that same thing with that person, right? And you want to request whoever's going to be the person managing your property is the one that comes to assist you with the due diligence, so that you can essentially do that kind of in-person interview. That is really, really key. All right, so you've got a property, you've got people managing it for you. What does asset management look like in terms of communication? And we've kind of touched on this, but the difference between property management and asset management is property management is the day-to-day signing leases, getting units cleaned, painting walls, mowing the grass. That's property management. Asset management, which is the role of the investor or the investor's company, is preparing, shaping, and communicating the vision for the property, making sure that the property is on the 5-year plan or the 10-year plan, or that you're in the process of taking the rents from 1,000 to 1,300 or whatever that is. So asset manager is higher level, bigger picture. It's guiding people. It's empowering people to do a good job. It's not. Asset management is not, again, taking leases and doing little day-to-day stuff. Ideally, as an investor, you want to be a good asset manager and not necessarily in the weeds of day-to-day property management. Again, unless you enjoy doing that, or you want to do it for the learning purposes, or you're just not at the larger scale yet. So we have a policy. We talk with our on-site staff weekly. And, we have a standing call for us. It's every Tuesday. And we have a go through call with each property. Tuesday is a very long day for me on conference calls all day long. But we cover a variety of topics. Number one, we go through an update on any renovation projects that we're doing. That could be, putting on new roofs, new parking lots, could be renovating units, doing upgrades, any of that kind of stuff. We follow up on action items from the last call. So one tip that I would give everybody is when you're managing your properties and something comes up like, oh, the sewer line's backed up in unit 5A, keep a running log of your meetings somewhere, right? So we do it in Evernote. For each property has its own Evernote, and we'll just say, oh, we'll if something comes up like a sewer backup on one week's call, we'll make a note, and then the next week we'll ask about that. So, hey, do we figure out why the sewer backed up? Did we get that fixed, or anything that applies to that? So you want to keep a running log of follow-up items, and then any management company or even somebody working directly for you should give you a weekly report on the property. Now, I will say that probably does not apply to a single family house or maybe even a duplex, but once you get past 4 or 5 units, your management company should be sending you a report every Monday that details the collections. Actually, you know what? We're going to go through that a little bit more here in just a minute. So let's go ahead and jump ahead. So all right. Okay, weekly reports. So what's included in the weekly reports? And this also, when you're interviewing the management company, you want to ask them about like, hey, what do they do for reporting? How frequent is it? And what's included? So weekly reports are a real big one. And so some of the things that you want to have in there, number one, collections, right? So each week, how much money has been collected, what's the total for the month so far, and then what are they projecting to hit by the end of the month? How much delinquency is there, right? So delinquency is how much rent is due but has not been paid, right? So let's say you've got a duplex and your rent is $1,000 a month on each half, and you have one person who hasn't paid rent for 2 months. Your delinquency is $2,000, right? So delinquency is rent that is owed but has not been paid. You want it to have occupancy on there, and not only just the occupancy, but you want physical occupancy and then leased, right? So if you've got 10 units and 9 units are occupied, you have 90% occupied, but the 10th unit is leased and the person's gonna be moving in next week. That means you're 90% occupied and 100% leased. You want both of those numbers on there so you can see where you're trending. The next thing we want to have on there is traffic, right? And that doesn't mean how bad the roads are in front of the property. It means how many people called, emailed, walked in the front door, toward the property, all that. You want to monitor traffic so you can get a sense of the level of demand for your property and if it's going up or down. And if it's really high, then that might mean you need to increase rents. You want status of the units, right? So if you've got 4 units, you want to know, are they occupied? And then if it's vacant, is it vacant and ready to be leased? Is it vacant and already leased? Is it vacant and needs to be repaired? Also, you want to know, do you have occupied units where the tenants have given notice, right? You want to know that, oh, hey, yeah, I'm 100% occupied, but 3 people are moving out next week or next month, right? So you need to plan for those repairs and then the leasing. So those are those are a lot of things on there. And then also we have past and current rents. As an investor, it's really, not only is it informative, but it's fun to have on your report what the rent was the day you took over, and then what it is now, so you can see that gap hopefully grow over time as rents go up, and you say, wow, I've owned this thing 3 years and rents are up 15%, and especially if your property management is doing a great job. So those are some of the things that we want to see on the weekly reports. If you have any questions about any of those, again, go ahead, throw them in the comments on Facebook and make sure this is refreshing, and then also on Instagram, and we will keep on rolling. All right. Next up is the monthly owner reports. These are the financial reports that you should be receiving from property management every month, surprisingly, right? Let's see. To Rita asked on Instagram, does that have to be weekly or can it be monthly? That's a good question. I mean, if you're on larger properties that are maybe 30, 40 units on up, I would recommend weekly. If you have, duplexes and maybe fourplexes or definitely single family, I think monthly is probably fine. And it really kind of, the idea is because you definitely don't want to ask for reports and communication that aren't informative, right? You don't want to waste your time or theirs. But you want, the idea is that you're very closely keeping your finger on the pulse of the property, right? So again, with a duplex, fourplex, monthly is probably fine. If you're at a 10 unit, I would start requiring weekly, because you're going to want to know if you got 2 units vacant or coming vacant or anything like that. Somebody asked about my background here. That's actually, no, it's not a picture of Rincon. It's actually a spot in French Polynesia, and the board is not a prop. That actually was used this morning. So that is that definitely is one of my hobbies here. So, all right. Let's see. Someone asked here on impact reports. Again, fourplexes on down. I think monthly reports are the minimum. Once you get up to about, I'd say 10 units, that's when I would want to start seeing the weekly reports. Because again, on a single family house, hopefully there's nothing to update on weekly, right? Hopefully the person's just paying rent every month and there's no change week to week. But if you've got 10 units, there's going to be changes week to week. Monthly reports, these are a little bit more in depth. I'm just going to go through quickly some of the things that we're looking at in those monthly reports. One, income and expenses. Thank you for the big stream of hearts there on Instagram. Much appreciated. So your monthly owner reports, you want to see income and expenses. And that's just what it sounds. All of the revenue that was collected, both rent and other income, late fees, water fees, trash fees, pest control fees, all that kind of stuff. And then all of the expenses. And that could be wages, property taxes, insurance, excuse me. Let's see what, utilities, licensing fees, all that kind of stuff. You want to look at that each month. And generally what you're looking for are changes or deviations from the trend, right? If the landscaping is $300 a month and all of a sudden it's 600, you need to ask why, what happened. Or if the water bill, and this is one of the most important ones to watch, the water bill is normally $300 a month and all of a sudden it's 500, and then the next month it's 600, and then the next month it's 650. Something's going on, and your property management company, or you, if you're that person right now, needs to jump on it and figure out, do you have a tenant who's abusing the water usage? Do you have underground leaks somewhere? Those are some of the things you're looking for. Changes in trend or deviations for all your expenses. And are there any expenses that perhaps you can find a way to lower them, right? So you're also looking for accounts payable. What that means is accounts payable are bills that you owe, right? So maybe you had a plumber come out, they charged you $500, you entered that invoice and you need to pay that, but you haven't paid it yet. That $500 is a payable, right? So what some management companies will do, either intentionally and sometimes unintentionally, is they will not pay bills on time to make the expenses look better than they really are. And if you notice that the accounts payable is going up, then that's a red flag to tell you that that's what's going on. So not only do you want to watch for that on your properties, but if you're buying properties, go look at the accounts payable. If there's a high number there, get clarification on why. It could be that they're trying to make the property look better than it is, or maybe the owner is short on cash. And if their property is doing great, you want to find out why they're short on cash, because they shouldn't be, right? So and then you want to look at distributable cash position. So how much cash do you still have in reserves? How much can you, if you have investors, how much can you distribute to them? If you're the only investor, how much can you take, right? Because you deserve to earn a living for this as well. We already touched on a little bit macro trends. Are expenses going up? Are they going down? Is revenue going up consistently? It should be if you've been owning this for the last few years. And then, is there room for rent increases? If rent's been the same for even 12 months, you're probably behind the market. So So those are some of the things we're looking for on a monthly owner report. We could do an entire hour-long session on monthly owners reports. Probably put everyone to sleep because it's all financials and detail, but it's incredibly important, and you want to make sure you are at least looking at those 5 things. All right. So we'll touch real quickly on annual budgets. Again, this probably won't apply if you're doing single family and fourplexes or smaller properties. This is mostly, I would say, 10 units and up. But I would say, even if you are self-managing your own fourplexes, take a few minutes and create a budget so that you have an idea, something to compare against of what, how well your property is performing, right? So and it doesn't have to be January, as long as you do it once a year or so, but pick a time, sit down, say, okay, I really feel like the income should be this for the next 12 months and the expenses should be this for the next 12 months. Put that in a simple Excel spreadsheet. Doesn't need to be anything fancy. And then again, whether you're managing it yourself or you got somebody else doing it, compare that with the actual performance and try to figure, and if it differs, figure out why, right? If you're higher, hopefully say, okay, well, did I underestimate something and we're getting more rents? Is there anything I can do to make it, better? Or if, you're collecting less than what you budgeted, well, why? Is it taking a long time to turn units? Are you not leasing well? Do you not have good enough traffic? And again, that's all questions either for your property management company, if you have third party, or yourself or your employee, if you're doing it in-house. So some of the things to consider when you're putting those budgets together, do a year-over-year comparison. Now, if you got a brand new property to you won't be able to do this, but if you've already owned the property for a year, look at what your income and expenses were the previous year. And then based on that, you can try to predict the next year. Again, where do you want to take revenue? If you collected $10,000 a month last year, can you get to $11,000 this year? Expenses, and I have on here on the slide, expense creep. How do you mitigate that? Expense creep is I swear it's got to be a law of physics somewhere, but expenses just seem to creep up a little bit every year. And a lot of that doesn't get noticed. And then all of a sudden your expenses are way higher than they should be. Vendors start charging you more. You're paying late fees on bills. The cost of utilities is going up. You want to watch for expense creep, especially on stuff that you can control. What projects are you going to do? So you want, also part of this budget is capital expenditures. Are you going to replace the roof? And that's going to cost you 10 grand. Are you going to replace water heaters? As everything brand new, you don't really need to, you're not planning on doing much. And again, compare that with what actually happens. Then let's see here. Also, just take a look at, what kind of risks do you think that maybe rents are going to turn and start going down in the next 12 months? Are you maybe at risk of a huge property tax reassessment? And you want to kind of keep those things in mind as you're forming your budget. And again, even if you're just self-managing a duplex or a fourplex, this is a really good process to go through. It's number one, to help hold yourself accountable. And then when you do eventually scale up and do third-party management or form your own property management company, you're already going to have these systems and processes in place. Let's see here. Julie Pre on Instagram says, thanks for your time. Really educational. You're welcome. I enjoy doing it, and glad to hear that it's helpful. And again, thank you for all the hearts here on Instagram. All right. We get, it's like, okay, Andrew, who sets up the bank account? Who gets access to them? How does all that work? Obviously, if you are self-managing, that's pretty simple. You're going to open the bank account and you're going to have access to it and you're going to manage that bank account. So what happens when you have third party? Generally speaking, what we like to do is we like to open and own the accounts and then add the third party property management company to the account so that they can pay the bills, deposit rent, and do all of that. Now, in most states, if you have security deposits and things like that, you have to have a separate account for security deposits. So that could be another account that you might need to form. So you're always going to have your operating account. And in many states, if you're taking security deposits, you're going to need to have a security deposit account. And then what what we recommend that you do, especially again, if it's a larger, more than 4 units and it's by third-party property management, ROI DuPont, you just asked a question I was about to answer. You're good thinking. So he asked, should you have separate accounts for reserves? Yes, that's exactly, you're a step ahead of me. We always maintain a separate account for reserves that the property management company does not have access to in terms of being able to spend that money, right? So now the property management company that we work with, we fully trust them. That's not an issue, but it's always good to have a little bit of separation of powers, right? I mean, think about the U.S. government. You got 3 separate branches that, in theory, are independent and separate from each other and can be checks and balances. So if you've got a third-party property management company and they have you've only got 2 accounts and they have full access to both of them, it is possible that you could get a bad property manager who runs off with all the money or steals the money, or your own employee could do that, right? So if you've got your reserve account that they don't have access to, the worst case scenario is you're only losing that month's deposits and you still got your reserves and you're fine. So yes, we absolutely have our separate reserve account. The property management company can see it, so they can do the accounting, but they don't have direct access to it. And one additional thing, and this is just a matter of preference. I don't say you have to do this. That for us, that reserve account is actually at a separate bank, right? We got 2 different banks, so that way, something happens, with a bank, or banks do close, and if they do, they tend to do it overnight. Something goes wrong with the bank, or someone gets access, or the bank is hacked, or the information gets stolen. We've got money in 2 separate locations so that the property will hopefully be minimally impacted. So great question. And then if you're doing larger properties or using a property management company where they open the account, that's totally fine, as long as they add you as a owner and signer on the account. Alium117 on Instagram asks, when can the property become an LLC? It's just a matter of how you want to be structured, and also the expenses in your state. So in California, the bare minimum is $800 a year just to have the honor of owning an LLC, regardless of that LLC does anything. So if you've got a single family house, that can be kind of expensive. If you're in a state like Wyoming, where it's pretty easy and inexpensive to have an LLC, yeah, maybe you maybe you create what's called a series LLC, and each house gets put in a cell of that LLC. I would say that once you get to larger properties, 10 units on up, you almost always want to have that property in its own LLC and treat it as a separate business, so that you don't have the risk of liability from that property spreading over to your other assets. So it's a function of cost and complexity, right? So, and then, all right, we have a follow-up question on Instagram. ROI says, so operating expenses would come out of the main account where rents are deposited? Absolutely. Ideally, rents are deposited into the operating account. All operating expenses are paid out of that account, including the mortgage, and then there should be some money left over at the end of each month. And what we like to do, or what I recommend doing, is leave a little bit of extra cushion in that account in case something unexpected comes up. And then if you either need or want to, you can set an automatic amount or whatever for every month that either goes to your reserve account to keep building that, or goes to you as a distribution, or to your investors as a distribution. So yes, you're absolutely right. All right, we'll keep on going here. Aligning interests. So this is key. How do you get the on-site staff or the property management company to care about your property as much as you do? And the short answer is just make sure your interests are aligned, where if you're succeeding, they are succeeding as well. And because that's one of the things with property management, and why in many cases it gets a bad rap, is because it's often a stressful, high demand, low reward job. And if you can fix that, then you're going to have much better results. And candidly, I think that's one of the keys to why our properties have done so well, is putting the right people in place, and then really uh, doing everything we can to empower them, treat them well, give them autonomy, and also pay them well for a job well done. Let's see here. So, all right, how to reward staff. Man, everybody's on point today. We got Joe McCullough on Facebook just asked, can you give us some examples of your bonus program and what metrics you use to set up the program? That's the first thing right here on the next slide. So, how to reward staff. Number one is NOI bonuses. That stands for net operating income, so income minus expenses. What we do is, I mentioned earlier, we set up a budget, and then and so for each quarter, there's a budgeted net operating income. And after the end of the quarter, if the net operating income hits the budget, then the property management staff, they get a bonus. And if it's above the budget, they get a bigger bonus. So I hopefully can remember the exact numbers. So we have a property, we do this at all properties, but we've got one property we just did bonuses on. And I believe the structure is if they hit the net operating income budget, there's two staff. They share an $1,800 bonus pool. If they're more than 5% above the budget, that pool doubles. And if they're more than 10% above the budget, we add like another $1,500 or something onto it, right? So the numbers, don't necessarily matter to any of you listening. But what does matter is if the thing to take away from this is you're managing the people managing your asset, their compensation goes up with performance. And the idea that you want to communicate is like, hey, if you're beating the budget, if you're increasing NOI, you're helping me make more money, and I want to share that with you. You should participate in that as well. And that's what a bonus program is for. So that if they have and they put in a ton of effort and sweat and tears, and again, property management is not easy. Almost anyone can do an okay job, but it is not easy to do a really good job. If they do a really good job, you want to make sure that their interests are aligned and that they make more money by doing that. And it's not costing you anything, right? It's don't make the mistake of seeing those bonuses as an expense, seeing as they earned because of them, you now have extra money and you can return some of that to them. So now that everybody wins. So that's the idea. The next thing is pay above market. This is one of the biggest mistakes I see multifamily investors make these days is when they're budgeting for how much they're going to pay people, they put it on the low end of the range. It's always true that you get what you pay for, but especially in today's market. I would recommend paying at the top of whatever the range is for your property, and especially if they're doing a great job, make sure that you're keeping pace with wages. So don't make the mistake of trying to cheap out on wages. That is the last thing that you want to go cheap on. Also, you can offer staff reduced living expenses, right? So, maybe you've got a 10 unit and, you want to make sure that the grounds always look nice. You can offer one of the residents, say, hey, I'll give you $200 a month off your rent if, once every 2 days you walk around the property and pick up all the trash and cigarette butts and just keep it nice and clean, right? So that's generally, not taxed to them. It's and so it's almost a free $200, and it's a discount. So that's another way to reward staff. Also, when you have good people working with you, give them the autonomy to make decisions and be able to grow professionally. Basically what that means is let them know, don't micromanage them. If let them, I'll give a perfect example. We had a property that got heavily damaged by a hurricane, and so we had to do a ton of work to it. And one day the property manager sends us a picture, and she's like, "Hey, I thought there's some stone on the end of the buildings." And she sent me a picture and said, "Hey, I thought this stone would look really amazing if we painted it, whatever, I think it was a gray color or something like that." And she just did it, right? And sent us the picture. And the regional manager was like, "Oh crap, you're not supposed to do that. You need to ask first." But I told her, no, this is okay because we could always paint it back. And because she knew that we want her to be able to make decisions, and part of it is that manager makes good decisions, and so we trust her. And she runs those properties like she owns them. And part of it's just because that's the kind of person that she is, but also because we let her run the properties like she owns them, to a certain degree, within reasonable bounds. But when people feel like they have the ability to make decisions and have empowerment, they're generally going to perform better. And so I highly recommend doing that. Set proper parameters. You don't want to you don't want to say, have someone just decide they want to put on a new roof without letting you know. But stuff that can move the needle in a positive direction, you want to allow them to do that. So TLC Marie on Instagram said perform to be rewarded. That's really exactly it. Let's see here. So your main job is to empower and enable them to do the best that they possibly can. And also, if you've got a great person working with you, fight the temptation to hold them back, right? Hopefully you can buy more assets and have them grow and move up with you, and don't just keep them at the exact level that they started at. All right, here's the big one: disposition. So this is something you hear a lot, like, when people go to sell a property, many times they'll try to hide it from the management company. And the justification they give for hiding it from the management company is like, well, I don't want the staff to quit, or I don't want the management company to stop leasing or stop managing it. And those are all legitimate concerns, especially if you have a mediocre management company. So how do you mitigate that? Number one, don't hide it from them. First of all, most of them can tell, right? Second of all, just be open and transparent and say, hey, you know what? We're going to put this on the market, or we're going to take an unsolicited offer. We're going to sell this in 3 months. Let them know what you're doing, right? But then, okay, so now you're telling them, hey, you're going to be out of a job in 3 months. How do we make sure they don't disappear on us and leave us with no property management, and they're off doing other things? Well, again, it gets back to aligning interests. So what we do is we do what we call stay on bonuses, and meaning that if the staff or the person managing the properties, if they stay until the end of the sale, we give them a very significant bonus. In some cases, that's 1 month's pay. In some cases, it's been several months' pay. And what we do is we have a base. We say, hey, if you stay until the sale closes, you are guaranteed to get this amount. And then here's the trick that I recommend everyone do. And then again, this could be either with a person on site, or you could even offer this to the company itself, the management company itself. We say that here's a base bonus for staying on, and then for every dollar above a certain price that the property sells, we're going to give you a small percentage of it, right? So maybe you think your property is going to sell for $1 million, and you say, okay, everybody, if you guys stay to the end, you'll get a $5,000 bonus. And then for every dollar above $1 million that it sells, we'll give you 2% of that, or something like that. So what does that do? That ties your interest with theirs. They have an interest in making sure that property sells for as much as possible, meaning they're going to keep it looking clean. They're going to keep the revenue high. They're going to keep the expenses low. They're going to keep running it as best as possible, because they're going to benefit from it just as much as you are, right? So we have a property now that we're selling in Atlanta where we set this program up, and the property ended up selling for almost 20% over our initial target. And so the staff at that property, their bonus basically is going to be 6 months of pay. They're ecstatic, and so are we, because we on that sale are making far, far more than we ever anticipated. So are we paying above market bonuses? Absolutely. What is it worth it for us to do that? You bet it is. And would those people come work for us again? Yeah, they absolutely would. So it's a win-win for everybody, right? So those are just some of the ways that you can tie, pay to performance, and then also align interest. And that's really the biggest thing to take from this, is you want to, always do everything you can to align the interests of the people helping you run your business with yours. If you're doing well, they should do well also. So, all right. I know that was a ton of information, and it was a bit dense. The good news is, like I said before, these presentations are recorded by Bigger Pockets, so you can go back and find the slides, take notes, whatever information that you need to get out of it. That actually concludes our 8-week series. So enjoyed talking and interacting with everybody. If you have any last minute questions right now, go ahead and throw them up, and I'll try to jump on and answer those. We got just a couple more minutes. In the meantime, I've seen a few questions come by of, should we buy right now, or price is too high? Should I wait? Generally speaking, it is always better to buy real estate and wait than to wait to buy real estate. While the market right now is not risk free, it would appear very likely that we're going to be heading into an inflationary environment, and inflation is a time when you want to own hard assets like real estate. So I would say yes, now is the time to buy. And just make sure that you're buying in a good market with population growth and income growth, right? Go back to, I think it was week 3 where we talked about that. How do you pick the right market to almost guarantee your success? And also keep in mind, hey, maybe prices do come down a bit in a couple of years or for a couple of years. That's okay, because as long as you can cash flow and pay the expenses and pay the mortgage, the current valuation doesn't matter. The valuation only matters when you buy it, when you refinance it, and when you sell it. So make sure that you're not over leveraged and that you're buying in a good area and that you can make the payments. And as long as you do those 3 things, buy it right, and then put the right debt on there, and then what we're talking about today, manage it right, then you should be in great shape almost no matter what happens with the economy. So I would not fear a dip or a correction. I would go, we're buying as much as we can today. We're doing it very targeted and very carefully, but we're buying as much as we can. And go back to some of our previous sessions where we talked about picking markets, how to do financing, and we went over some of the ways that you can mitigate that risk of, well, what if interest rates go up and what if prices come down? Don't let that scare you. Generally, the only people who lose are the ones who try to overly time the market. That every once in a while you'll get lucky, but the vast majority of the time it's a losing bet. So we've had a few people ask how to get in touch with me and will I be at BPCon. Unfortunately, I won't be making it to BPCon this year. Hopefully, maybe possibly the next time around. And then Bearded Marco asked, how do we connect with you? Of course, I am on Bigger Pockets. And if you'd like to get connected directly with me, you can just Google Andrew Cushman and all kinds of stuff will come up. But our website is vpacq.com. So Vantage is short for Vantage Point Acquisitions. Again, just vpacq.com. There's a couple of tabs on there that a few different ways to connect with me. And of course, if you have a follow-up question, you can ask that in Bigger Pockets or just connect with me directly. Again, I recognize some of you who've been here the entire 8 weeks. Really appreciate that. Hopefully this was useful for you and you've been able to put some of it to use in growing and expanding your business. And look forward to connecting further, hopefully on some additional Bigger Pockets mediums in the future. In the meantime, go out there, find a market, put a team together, identify some deals, start buying some stuff, and go build your real estate empire starting today. Joe McCullough on Facebook says, hey, this is great information. Thank you, Andrew. You're welcome, Joe. Glad you enjoyed it, and look forward to hopefully talking with everyone again soon. Take care.